And I'm looking to transition into more long-term wealth, building long-term wealth, something I can pass down to my son one day. And so I've looked at multifamily, I've looked at self-storage. I love self-storage, and I want to buy facilities and own them, but I really don't know how to evaluate them.
Correct me if I'm wrong. What I heard you say was you need a process or a system to figure out if this is even a deal. What does a good deal look like? Are there any gaps or holes there? Anything you can help clarify, or is that ultimately what you're looking for here?
If I find the facility, let's say it's in Georgia where I am, and it looks interesting to me, how do I run the numbers? How do I underwrite that deal? How do I know what a good offer is so that I can call the seller and make them an offer? At the end of the day, I want to buy and own personally. I want to hold, 3, 4, 5 facilities for the long term.
Welcome back, my friends, to the Storage Wins podcast, and I have something very different and unique for you on the podcast today. I'm going to be doing something that I have never done before. I'm going to be coaching somebody live on the podcast. Happens to be a friend of mine, Mr. Brandon Rickman, which I will introduce you to in a second. But Brandon is a successful real estate investor. He's got something really cool going on in the storage space, which I'm going to let him talk about. And I want to focus this particular podcast episode on 1 or 2 challenges or friction points that Brandon has in his storage business. Because my thought is, if I can help Brandon, then it will help you. Okay, if Brandon has some questions around a particular topic or area of storage, chances are you either have the same question or you will have the same question. So give me some grace here to do something a little bit different. I'm going to treat this, I'm going to be wearing the podcast host hat, and I'm also going to be wearing the coach hat. And again, my aim and goal here is to help Brandon and in turn help you, because if he's got some challenges and concerns or questions, then chances are you have those or you will have those in the future. So Brandon, man, with that being said, I want to kind of set the stage here, brother. I put something out on my social media and I kind of treated it as an experiment. I said, hey, I'm looking to maybe coach a few people live on the podcast. I had a lot more people reach out to me than I anticipated. Hopped on a phone call with every single one of those people, and you're one of the few that was selected for this. And I just share that just to let people know how we got here. You and I obviously have a relationship. We're part of a community of coaches and people that have a heart to want to help people through real estate investing. And man, I've just enjoyed our conversations. So I appreciate, number one, you. Number two, you reaching out, being willing to hop on the podcast, put yourself out there. And so with that being said, welcome to the podcast, number one. And number two, tell us a little bit about yourself and where you are in your storage journey.
Yeah, thanks, Alex. I appreciate it. Super excited to be on here talking to you. And I do have a lot of questions. I think I'm probably similar to a lot of your clients and your listeners to the podcast in that I've had some success on the single family side and have done that for years and years, and really looking to go more from a transactional business, which I consider flipping and wholesaling and even new construction. It's more transactional. You find a deal, you flip it, or you build a house, or you wholesale it. You got to go find another deal. And I'm looking to transition into more long-term wealth, building long-term wealth, something I can pass down to my son one day. And so I've looked at multifamily, I've looked at self-storage. I love self-storage, and I want to buy facilities and own them, but I really don't know how to evaluate them. So I've kind of, even though I have a development going, and I know we'll talk about that in a few minutes, I really want to do that for the long term. So I think I'm excited about this conversation, and I have a million questions. Hopefully we can squeeze it all into a podcast here, but I'm excited to talk to you. Glad that we have remained friends over all these years, originally in Collective Genius, I think together now in Tom Kroll's group, which we also met through Collective Genius. And, like you said, great people, great hearts, doing great things in the industry. And so just super excited to be here talking to you, Alex.
Yeah, man. Fantastic. Well, brother, let's dive into it. I know you got a lot of questions, and I don't want to overpromise and tell you that we're going to get to all your questions. So I want you to start thinking about, if you were going to consolidate your questions, or maybe questions that have some overlap or some common denominators, what would they be? It sounds like the area of the business that we're going to set our sights on and focus on comes to underwriting, right? How to evaluate these opportunities, the deal analysis process. And so I'm ready to tackle that. Now, keep in mind, obviously, we're on a podcast, and so I only have but so many tools here. If we could whiteboard this out, it would be better, but I can certainly show you some simple tools that we use. We can maybe take on a deal you're looking at if you want, or it could be a hypothetical, and I can kind of walk you through the process I go through. With that said, why don't you go ahead and just give us a little bit of background and context within a couple of minutes is what your storage business or what your real estate business looks like today, and then where you are in your storage journey. Tell us a little bit about that development project you've been working on.
Yeah, absolutely. So I started out flipping houses, actually. Had been doing that for over 20 years. We've flipped over 500 properties here in the Atlanta area. So done a lot of flipping, done some wholesaling, buy and hold. Primarily been on the single family side. So we have had some short-term rentals, long-term rentals, and then a little bit of everything on the single family side. And so we've evaluated a lot of deals. I know how to underwrite single family stuff. I've looked at some multifamily and self-storage, like I said, but I've never really had been taught or learned exactly how to underwrite those to know if it's a good deal. So as far as talking to potential sellers, negotiating, I think all that I understand. I'm assuming it's similar to what we do in the single family space. But I've never done it in the self-storage world. So that's kind of where most of my questions lie, is like, how do I find the properties? Obviously, you can look that up and search by data for storage facilities to mail to, or you can call them, skip trace them and cold call them, similar to what we do in the single family world. So that part is not as concerning. It's just I don't know how to look at a deal and know, is this a good deal and what should I offer? And like you said, do the underwriting. The self-storage development deal that I did, because I've been looking at self-storage for years and years and trying to figure out how to get into it, I came across 2 houses that were for sale from another wholesaler, and they were next to each other. It was 4.5 acres combined. And I put it under contract because the price, I was looking at it just to flip 2 houses beside each other. And when I was doing my due diligence while it was still under contract, I found out that the future land use map for the county showed it as general commercial. Okay. And so I thought, wow, that's kind of interesting. It was right next to a brand new Walmart, and it was on a big major road. And so I thought, that's kind of interesting. I wonder what is allowed under that zoning. And so as I started going through it, I realized that the land probably had more value than the 2 houses that were on them. So I reached out to a friend of mine who was a broker. He told me what he thought the land by itself was worth, which was almost double what I had it under contract for. So I went ahead and closed on the property and then took it through zoning myself, got it approved. That took about 5 to 6 months to get it approved for a self-storage facility. And at that time, I had never done a storage facility before. So I'm like, okay, great. Now I have the zoning approved and I've got 4.5 acres, but what do I do now? So I ended up reaching out to a buddy of mine who was also in Collective Genius with us, who has done some self-storage development, brought him in as a partner, and we are now about halfway through building out 115,000 square foot Class A 3-story facility. It's got 865 units in it. So I kind of went from, I've never done this, to we're going to take on the most difficult part of self-storage right off the bat. So but that's kind of where we are with that one.
So you embody, I talk about in our Storage Wins community, I've shared this on the podcast and in my YouTube channel, like taking massive imperfect action, right? You've heard that saying before. You embody what that means. I mean, you didn't jump into the deep end of the pool. Like, you took a boat out into the ocean and then you jumped in the deep blue sea. And I love it, man. Like, one of the things that I think is really wise about what you did is you recognize that this is an asset class you've never done, and so you found somebody experienced in it that has done that type of play before, and you brought them into a deal. And one of the things I always think about, a friend of mine told me this years ago, it always stuck with me, Brandon, is I'd rather have 50% of a watermelon than 100% of a grape. Absolutely. You know, and I love the fact that you had the land, you recognized the opportunity in terms of the zoning for storage, and then you just found the right who. And I always talk about finding the right who, asking that question, not necessarily how. And if you haven't read that book, Who Not How, by Dr. Benjamin Hardy, I would highly encourage you to read that book. But brother, again, man, my goal here is to deliver just value, and I want to help you, and I want to give you some clarity here. So do we want to focus on underwriting? Like, I think, let's get clear. Whenever I coach somebody, I like to get clear on the challenge or the problem we're trying to solve, and then just focus all of our energy and attention on that. Correct me if I'm wrong. What I heard you say was you need a process or a system to figure out if this is even a deal, what does a good deal look like? I'm paraphrasing, but are there any gaps or holes there? Anything you can help clarify, or is that ultimately what you're looking for here?
No, I think that's it. I think you hit the nail on the head. It's, if I find the facility, let's say it's in Georgia where I am, and it looks interesting to me. How do I run the numbers? How do I underwrite that deal? How do I know what a good offer is so that I can call the seller and make them an offer? At the end of the day, I want to buy and own personally. I want to hold, 3, 4, 5 facilities for the long term. And this development deal is most likely build and sell kind of thing. So it won't be something that I hold long term. It'll provide some capital for that. But ultimately, I want to buy 3 to 5 facilities that I own myself for the long haul. So I want to learn how to underwrite those and start making offers on them.
Fantastic. Okay, so let's start here. I want to start 30,000 foot view in terms of the mindset and how I think about this. And then we can start to get a little bit more granular and drill down into the numbers and like the actual process. Big picture. And by the way, this is my approach. There are different ways to skin this cat, right? This is one of the nuances of commercial real estate versus single family. As you know, brother, single family, we look at the comps. What have things sold for? Like properties, quarter mile, half mile radius, last 3 to 6 months. In storage, you have to understand that the value is driven by the income the asset produces. So we're not looking at comparable sales of other storage facilities that have sold. We are looking at the income it produces. And I think the first thing that's super, super important and by the way, I'm speaking more at those listening. I know you know this, but I want to be fully comprehensive here. So give me some grace for some of these things that you already know, Brandon. I think it's super important that when we underwrite or analyze a deal, that we're looking at it and we're going to make an offer based on the income the asset is currently producing. We're going to buy on pro forma, but we're not going to pay for pro forma. There's a huge difference and distinction there. When you look at offering memorandums from brokers, they will paint a rosy picture of what the facility could be in the future in terms of the value once you do certain things. And oftentimes they want you to pay for the value that the owner hasn't created. So I never want you to make an offer based on pro forma. I want you, yes, we're going to look at what the facility could be because we want to analyze the gap between what is it currently worth and what could it be worth if we were operating it. But I never want you to make an offer and buy on pro forma. So I just want to use that as the foundation of our conversation, okay? Then when it comes to actually underwriting, I look at underwriting, Brandon, in 2 phases. The first thing I do, brother, is I'm not trying to analyze and underwrite a deal right from the jump. When I see a deal, the first question I'm asking myself is this deal or is this opportunity worth more than 2 to 5 minutes of my time to go further? So that's the first thing I do. And we use something, in fact, let me just go ahead and I want to share my screen here. And then, brother, if you're open to it, I'd love to actually go into a market that you want or the market where you're developing, whatever you're comfortable sharing. And then we can look at some competitors because I like to source data from the actual market and from the competitors. So if you're open to that, I just want to plant that seed with you now so that you can be ready to share. Or we can go into a hypothetical, totally up to you. But let me share my screen here with you. And I realize if you're listening to this on the podcast, then maybe this is more reason to also subscribe on the YouTube channel so that you can see this portion of the video. But I will also walk you through this if you don't have the ability to go ahead and see this. So here's what I'm going to do is I'm going to show you a simple tool that we use inside of our community to quickly go through the underwriting process. And if I could get this to work, we were having a few issues with Riverside here. So here we go. Okay, let me know, Brandon, if you can see my screen.
I can, yes.
Okay, perfect. Now, so you should be seeing, this is our Storage Wins quick offer range and cap rate calculator. Can you see that?
I can. It's
fantastic.
Small. It's really small below our pictures. I don't know if you can make it.
Okay. Yeah.
Might be a setting on my end as well.
Okay, I just I expanded it a little bit. Can you see that better?
Okay, I can, yes.
Okay, fantastic. So let me walk you through. This is a simple tool that we use inside of the Storage Wins community that when our clients or when I'm speaking to a storage owner, there's just a few data points that I'm looking to collect to run it through this analyzer and this cap rate calculator to give me an approximation on what the value of the facility is based on a certain cap rate. Okay, and if I was going to simplify what a cap rate is simply, it's an expression of value. It's the return on investment that you would get if you were to buy that property with cash, excluding any debt service. And I know that you're thinking, hey, Alex, I don't have cash, I wouldn't be buying a facility with cash. Don't worry about that. Just understand that a cap rate is just an expression of value, and the cap rate is going to vary based on the size of the facility and based on the market. For the purposes of this conversation, let's just use an 8 cap as an example. Essentially an 8% return on your money. All right. So whenever I can connect with a storage owner, there's really 2 key pieces of information that I always like to try to collect from them. Number 1 is their monthly revenue. If I can get the annual revenue, even better, because with the annual revenue, I can just take the average, and that's a better number than if they just gave me last month's revenue, which could be their best month or it could be their worst month. They could be in a market that's very seasonal with storage or not. So if I can figure out what their average monthly revenue is, then all I have to do here with this simple tool is just plug in the number in this particular cell, and it's going to give me an offer range based on a 12 cap or an 8 cap. And anything in between. All right, so give me an example of just any monthly revenue number that comes to mind or that you've recently heard in talking to any storage owners, Brandon.
$20,000 a month.
Okay, so if Brandon was, or if you were talking to a storage owner and they told you that they're generating $20,000 a month, all you do is you put in that number here into the monthly gross revenue, and that means it's going to tell you that you're going to probably give them an offer somewhere in the range of 1.2 million to 1.8 million. 1.2 million is based on a 12 cap. Okay. 1.8 million is based on an 8 cap. And you could likely be anywhere in between. Now, it doesn't mean I'm going to give them an offer of 1.2 or of 1.8, but when I'm on the phone with someone, it just gives me a quick range of like, hey, what ballpark would I even be in based on an offer of an 8 to a 12 cap, okay? So that's the first thing. I just want to see, like, am I even in the ballpark? I always like to find out what's their monthly revenue. If I can get the unit mix, that's huge, right? Because the unit mix and their current rates, because what I will then do is I will go to the market and I will do some simple analysis to determine what is the average street rate in that market, and I will compare it to the current rental rates of the facility that I'm looking at potentially making an offer on. Ideally, Brandon, we want to see the bigger the gap, the bigger the delta between the average of the street market rates and the current rates of the facility, the more opportunity that represents for us. Okay, I'll get to that in a second. I just wanted to just go ahead and share that with you. Now, look, sometimes the owner doesn't know the monthly revenue number. So if I already know what the average street rate is, in other words, one of the things I like to do is I'll go to the competitors in the market within a 5-mile radius. I'll go to their website and I'll look at their 10 by 10s. And let's say I look at competitor A and their 10 by 10 rate is $60 a month. I will look at competitor B and their rates are $70 a month. Mm-hmm. And let's just say there's only 2 competitors. I'm going to average that out and say, hey, their 10 by 10s are selling for $65 a month on average. Well, if you take a 10 by 10, that's 100 square feet of storage. 10 times 10 is 100 square feet. If you take 65 divided by 100, that tells you that the price per square foot is 65 cents. Mm-hmm. Do you follow me so far, Brandon?
I got you. Yep.
Okay. So if you look at this part of the spreadsheet right here, and this is when you know the net rentable square footage of the facility. And you can use Google Maps, use the measure distance tool where you could just click around and it'll tell you the approximate square footage. This hypothetical $20,000 a month revenue facility, how many square feet is that facility, Brandon? You can just make up a number if you don't know it.
Let's say 40,000 square feet.
Okay. So right here, I'm going to type in 40,000 square feet. And let's just stick with this hypothetical that it's 65 cents a square foot in this market based on the process I just shared with you. The next two things I want to figure out, and I think it's super important that when you analyze and underwrite a deal, I tend to err on the side of being conservative. And what do I mean by that? I will never underwrite a deal based on 100% occupancy or even 95% occupancy. I like to assume 85 to 88% occupancy, which means I'm going to have 12 to 15% vacancy. Whenever I speak to storage owners, Brandon, sometimes they brag about the fact that they're 100% occupied. And what that tells me is that they're likely not very sophisticated and they're leaving money on the table. If you're at 100% occupancy, that means you're probably not charging enough in rent. And you always want to have some available units to be able to rent out. So as a sophisticated storage owner operator, you want to put upward pressure on the market street rates. Okay, you always want those rates to be rising. So if I'm going to assume a 15% vacancy rate, which means 85% occupancy, I'm going to put that in here. And then the operating expense ratio in storage, generally speaking, is between 30 and 40%.
Okay.
So what does that mean? That let's say a facility generates, in this particular case, well, let's just use simple math. Let's say a facility generates $100,000 in annual revenue. That means that it's going to take $30,000 to $40,000 in order to generate that $100,000 in revenue. So that would be a 30 to 40% operating expense ratio. As a rule of thumb, the smaller the facility, the higher operating expense ratio you're going to want to use in your underwriting.
Okay.
The bigger the facility, you can likely achieve a lower operating expense ratio. So look, in this case, this is a 40,000 square foot facility. If I was going to be super conservative, I would use 40% operating expense ratio. Because this is a big facility, let's just go ahead and use a 35% operating expense ratio. So I'm going to put 35% here. And then based on the calculations of this spreadsheet, it tells me that my projected annual net operating income is $172,380.
Okay.
And for those that might not be sure, net operating income is simply calculated by you have your revenue minus your expenses. That gives you your NOI, your net operating income. That is the number that determines the value of the facility based on what it's currently producing. So now let's skip down here to this cap rate calculator that I like to use. So I'm going to go here and I'm going to change this number to 35%. So right here, this number in the yellow cell, let's just stick with the same 35% expense ratio. And let's use Brandon's $20,000 monthly revenue, which is $240,000 annually. So if Brandon, if you go down here to 20,000, which is cell or row 38, okay, we're going to assume based on a 35% expense ratio that the expenses for that facility are around 84,000. So what does that mean? That means that if we look at the value of this facility, the value is going to be at a 12 cap, it's going to be 1.3 million. All the way to this cap rate calculator goes to a 4 cap, which is 3.9 million. So what's the ratio you have to understand? The lower the cap rate, the more valuable the property is. The more you're going to pay for it. The higher the cap rate, the less you're gonna pay for it. Okay. Usually, I think a good rule of thumb is the higher the cap rate, oftentimes that comes with more risk. The lower, but higher returns. The lower the cap rate, it can come with less risk, but less returns as well. Does that make sense?
It does, yes. So when I'm buying a facility, in other words, I want to buy at a higher cap rate a 10, 11, 12 cap when I'm purchasing a property as opposed to a 6 or a 5. Correct?
Yeah, look, if you can achieve that. Now, here's the caveat to everything we just shared. Even though I'm showing you a cap rate calculator and we're talking about cap rates, I think sometimes people overstate the value of a cap rate when buying. At the end of the day, I'm looking at a deal and I'm asking myself, what is the value add opportunity and how much value can I create here by forcing the appreciation? What does that mean? In storage, we can force the appreciation. In other words, we have more of an impact on determining the value of the facility, at least compared to our friends in the single family space where they can't really force the appreciation. It's more based on comparable sales. So yes, I'm looking at a cap rate, but I'm not necessarily putting all my eggs in that basket to help determine what I'm going to offer. Because at the end of the day, like, look, my first storage facility, Brandon, that 43,000 square foot facility in Mississippi, I think I bought that like at an 8.2, 8.3 cap, which is not great. But I knew that the income that facility was generating was significantly less than what it could be generating once I raised the rates, once I implemented my systems, once I added fee income. And so when I determined that, hey, this deal makes sense to go deeper, I then took it on to my full underwriting spreadsheet, which I'll show you now in a second. And that is what spit out certain numbers like my cash on cash return. Like what is the net cash flow this facility will produce once I factor out annual debt service? What is the return a potential equity partner is going to receive on this facility? So whenever the first thing I'm looking at is, hey, is there an opportunity here? And does this deal deserve more than a couple of minutes of my time, energy, and attention? And I will often use this tool to determine like, hey, am I even in the ballpark with the seller? And if I'm not, it doesn't mean I'm not going to make an offer. In fact, that's a mistake I think a lot of people make, Brandon, where just because a broker or a seller is asking this and their offer is here, there's so much of a gap that they don't even swing the bat and make an offer. And I've seen people in our community win and succeed because they frame the offer before they send it. And I've had conversations with numerous brokers that tell me like, Alex, we need offers. Even if it's lower, just share why you got there or how you got there, and then we'll go to bat for you and we'll present it to the seller. So if you get nothing else out of this conversation, for those listening and watching, make the offer no matter how far you are. I think it's just a matter about how you frame it and creating a soft landing zone for the seller, so to speak. Okay. So I want to kind of pause here because really what I'm hoping you're getting from this part of the conversation, and I want everybody, is the first thing I'm doing is just determining, like, I'm just getting a few key pieces of data, and that could either be the annual revenue or the square footage of the facility. If I can't get the annual revenue, just get the square footage and then figure out what the average price per square foot is. And I just, for simple math, I like to use a 10 by 10 unit. I have some friends that will get even a little bit more in depth, and they'll take the average of a 10 by 10 unit and a 10 by 15 unit. And that, more times than not, will give you a pretty good estimate on the price per square foot of that particular market. So if you don't mind, Brandon, let's actually, do you want to look at your particular market where you're developing your facility?
Yeah, absolutely.
Okay, so here's what I'm going to do. I'm going to go to maps.google.com. What city, state is your development project in?
Lawrenceville, Georgia.
Lawrenceville, Georgia. Okay, fantastic. Okay, so Lawrenceville, Georgia. So I'm on Google Maps. I just typed in Lawrenceville, Georgia. I'm going to click on the nearby button, and I'm going to type in self-storage. And what this is going to do is, in a moment, you're going to see a bunch of red dots on the screen. And let me know if I need to expand this so you can see it a little bit better, Brandon. But what this is showing me is the Google Map Pack. In other words, these are the storage facilities that Google is picking up in the area. Now, it doesn't mean that these are all the storage facilities. one of the things that I like to do is go flying for dollars, meaning I'll do an overview of the market, and I've trained virtual assistants on how to spot the long rectangular caterpillar looking buildings, which are storage. And sometimes we spot opportunities and storage facilities that don't have a Google My Business listing. Okay, that's like the equivalent of a vacant boarded up house, Brandon, that is not on any list. Okay. Right? So that can represent an opportunity. Now, the first thing, I'm going to assume that Brandon's already done the market research, that he knows there's demand for storage in this area, because I think a mistake that I've seen storage developers make is that they will build and erect storage in a market that is overly saturated with storage or that doesn't have enough demand for storage. Brandon partnered up with somebody who's done storage development. So let's move past that. Let's assume the market we're in has demand for storage, meaning there's less supply of it and more people that need storage. And there's an equation called the square foot per capita, or the supply index. That is a ratio that tells you the amount of people in a given 1, 3, and 5 mile radius relative to the total number of net rentable square footage of storage available. And I think the national average is like 7 or 8. That's just a piece of the puzzle. That's not a make it or break it per se. But you're in this particular market. What's the name, or can you kind of pinpoint more or less where your facility is located in this market?
Yeah. Also, I'm still seeing your deal calculator. I'm not seeing your Google Maps.
Oh, okay. I'm sorry about that.
I don't know if you can switch it over.
Yeah,
but I can give you the exact address of the property if you want. You can put the exact address in.
Yeah, let me go ahead and reshare my screen here, and that'll be okay. Perfect. So you should. Thanks for letting me know that, by the way. Okay, so you should see Google Maps right now.
I see it. Yep.
Okay, perfect. So what is
our property address? Is 2925.
Hold on one second. I'm going back to Google Maps. Okay, so if you have the address, just type it into the search Google Maps. 2925
Lawrenceville Highway. LAWRENCEVILLE. Lawrenceville Highway.
Okay, I think I got it right there. Okay, so is this it?
That's it.
Okay, perfect. Now I'm going to do the same thing. I'm going to click nearby, and I'm going to type in self-storage. Why? Because I want to see the self-storage that is in and around Brandon's development deal. Okay? Now, one thing, and I just want to share this for others that are watching this. One thing I noticed right out of the gate is that Brandon's facility or future facility is sandwiched in between an extra space storage and a public storage. As a general rule of thumb, and this is just me, there's a lot of, based on Brandon's buy box blueprint, and again, I don't know anything about Lawrenceville, Georgia. Brandon and his partner have done, extensive research on the market. I'm certain they've stress tested to determine if it makes sense to put storage here. So I'm assuming all that checks out. As a general rule of thumb, I don't typically look for storage in an area where there's heavy REIT concentration. And what I mean by REITs are real estate investment trusts like Public Storage, Extra Space, Cube Smart, Life Storage, U-Haul, KO. Those are the Class A facilities that can play a different game when it comes to rates. And I don't like to compete with that. We're more of a mom and pop product. And so that's why I tend to focus on smaller markets, tertiary markets, in some cases, secondary markets. So just a heads up, Brandon, and the supply and demand, I always want to keep an eye on any new construction or supply of storage that could be coming on the market. God bless you, by the way.
Okay, thank you.
So I like to go to the building department and find out, hey, are there any open permits for storage coming online? Because a potential risk for a developer, or even if you're buying an existing mom and pop facility, is buying a facility and then not knowing that in 3 or 6 months, 40 or 50,000 square feet of storage is opening up down the road. Right? So that is something that is super, super important. Like if I was looking to buy storage in Lawrenceville, Georgia, if I didn't do what I'm sharing with you now, and let's say I bought a facility and all of a sudden Brandon and his partner open up a beautiful Class A 100,000 square foot facility right down the road from my little mom and pop, that could crush me. Right? Like they could, so it's super important whether you're developing storage or you're looking to buy existing is check with the building department and see if there's any open permits for new construction coming down the pipeline. Because you might be in a market that you think is has a lot of demand for storage, but what you don't know is that in 6 to 12 months, there's 100,000 net rentable square footage of storage coming online that can totally throw off that supply index number. Okay? So I realize, Brandon, this isn't necessarily underwriting, but I thought it was important to mention that.
Yeah, it's great.
Okay, brother. So here's what I'm going to do is what I would typically do in this case is I would look at the closest facilities within a 3 to 5 mile radius. And I will, so like, let's go to Mini Mall, for example, which, by the way, I know is another pretty big operator. Look at that, 4.9 stars, 519 5-star reviews. You got some competition in this market for sure. I mean, you got, again, Extra Space, Public Storage, Mini Mall. You got some pretty big players there. So what I'm going to do is I'm going to go to Mini Mall Storage's website, and I'm going to look at their existing rates for a 10 by 10 to see if I can get an average between Mini Mall, Public, and Extra Space. Let's just get a sense. Now, here's the challenge, is that, you remember I told you that REITs play a different game when it comes to rates? This is a perfect example of what I'm talking about. Their advertising, let's just look at a 10 by 10. Okay, here's a 10 by 10 non-climate. Now, is your facility going to be climate or non-climate or a combination?
100% climate control.
Okay, so that's important. We need to compare apples to apples. So I'm not going to look at a 10 by 10 non-climate because Brandon's facility is going to be a beautiful Class A facility, which he'll be able to compete with the Public Storage, Extra Space, and that type of product. So let's look at a 10 by 10 climate controlled. Now, this is an upper level. Is your facility going to have multiple stories or is it single story?
It is. It's a basement and two floors above, so three stories total.
Okay, so look, in this particular example, they're advertising $12.50 a week, which, if my math is right, that's $50 a month. Okay? Now, $50 a month for a 10 by 10 climate controlled in a Class A facility is really cheap. Here's what these customers that are renting storage from these big box retailers don't know, is that they're getting them in at a super low rate. But in 30, 60, or 90 days, they're jacking the rates all the way back up. Okay? So that's what's a little tricky here, is that they're offering a first month free, and they're offering a $12.50 a week rate to bring people in. That seems really attractive, which, if you do the math, that's $50 a month. What I don't know is what is the rate going to be in 30, 60, 90 days. So for now, let's just earmark that Mini Mall Storage is at $50 a month for a 10 by 10, which, if you did $50 divided by 100 square feet of storage, what's the price per square foot there?
50 cents.
50 cents, exactly. So now that we have, so I would put that on my spreadsheet. 50 cents is the price per square foot on Mini Mall. Let's take a look at the next closest competitor. And just for the sake of time, I'm just going to go ahead and look at Extra Space here. And let's see if we can figure out what Extra Space is doing here. And you would do this process whether it's a REIT or not. Typically, I would do this with other mom and pop facilities in the area. But if you are a mom and pop, I'm not looking at the rates of a REIT if you happen to be looking for storage in that market, because it's not an apples to apples product. Okay, hopefully that makes sense. So let's look at Extra Space, and let's look at a 10 by 10. Now, this is drive up 10 by 10, so that's not what I'm looking for. I want to see 10 by 10 climate controlled. Okay, check this out, Brandon. Extra Space, their web rate is $75. And according to them, they only have one left. $75 divided by 100 square feet of storage, that's 75 cents a foot. So I would do the same thing for all the other competitors within the 3 to 5 mile radius, and I would then calculate what is the average price per square foot.
Gotcha.
Okay. Let's say the average price per square foot is 70 cents, right? for a quick back of the napkin, you could use that tool, which, by the way, I'll share with you that tool. And for anybody else listening and watching, we'll have a link in the description for you to be able to download this Storage Wins quick offer range and cap rate calculator. This just helps me determine, hey, are we even in the ballpark? So you can use one of two. You can use the revenue if you have it. You can use if you have the price per square foot and the square footage of the facility, or you can just jump right here to the cap rate calculator. And like, let's say you're talking to an owner, Brandon, that says, hey, we're generating $8,000 a month in annual revenue. Just use the cap rate calculator, go here. And so you know that if we were going to use a very broad offer range of as low as a 4 cap, which I would never encourage anybody to make an offer on at a 4, 5, or a 6 cap. But let's just say you're going to have an offer range. Hey, the value is going to be somewhere between $520,000 and $1.56 million, which is a very, very broad range. But just know that in this market, a lot of properties are trading in the 7, 8, 9 cap range. Okay. So in this hypothetical of a facility that's generating $8,000 in monthly revenue, the value of the facility based on the current cap rates is probably going to be somewhere in the $700,000 to $900,000 range. Right? I remember a couple of years ago, I had a conversation with a storage owner that told me, hey, it was a 21,000 square foot facility. They were asking $400,000. I didn't need a cap rate calculator or anything. Like, I gave her exactly what she was looking for. I knew it was a deal just based on the price per square foot. So one of the other things I ask myself when I'm just doing some simple back of the napkin is, hey, can I build storage for less than what they're asking? So let's say a facility is asking $1 million and it's a 30,000 square foot facility. Well, if I take $1 million divided by 30,000 square feet, that's going to give you the price per square feet, which in this case is $33.33. That's probably lower than what it would take to build storage in this market. I don't know, Brandon, do you know what your price per square foot is on this development project?
Yeah, we're in I think it's $78 a foot.
There you go. And that sounds about right. So if I was looking for storage in Lawrenceville, Georgia, and I could get a deal for less than what it would cost me to build, it doesn't necessarily mean you should do the deal and it's automatically a deal. There's never one particular factor that necessarily tells you do it or don't do it, but it is an important piece of that puzzle to know that if I can get a deal at 35 or 40 bucks a foot, you know, I know it would cost me probably $70 to $80 or more. Now, you have to kind of adjust because you might be buying a mom and pop facility, which is not the same product as what Brandon and his partner are putting out. Brandon and his partner are putting out a Class A, multi-story, beautiful facility. So you kind of have to adjust for that. But big picture when it comes to underwriting, Brandon, the first thing I really, and this is what I want people to walk away with from this podcast episode, is just quickly realizing and determining, is the deal worth going even further? And I like to use simple tools like this, whether it's a cap rate calculator or whether you have the facility square footage, the price per square foot, you can use that. Or even if you just have the revenue number and you just want to come up with simple back of the napkin analysis. And hey, I'm going to assume a 40% operating expense ratio. The facility is generating $100,000 in annual revenue. 100 times, you're going to back out the 40% expense ratio. So you would either do 100,000 times 60%, or you would do 100,000 times, if you're using a calculator, 1 minus 0.40, right? Mm-hmm. 1 minus 40%. And that's going to give you a projected NOI. And then if I have that NOI and I divide that by a certain cap rate, that will give you the projected value. So let's say it's a $60,000 NOI and I divide that by a 10 cap. Well, that's a $600,000 value. Okay. If I was buying it at a 10 cap. Does that make sense?
Yeah, that does make sense. Yes.
So, so here's what I'd love to do is, Brandon, I actually I got a call coming up here in a few minutes, and when it comes to underwriting, it's so much easier sometimes to whiteboard these things. Maybe what we do, man, is make this a 2-part episode where we take it a step further, because there's an additional spreadsheet that I have that is much more in depth, and that's what I go to when it comes time to figure out, hey, this is a deal I really want to go deeper on and I want to make an offer on. And that's when I'll do my competition study. I'll look at the market. I will figure out, hey, based on what I think I can get this deal for, what is the best way to structure it? Am I getting bank financing? Am I going SBA? Am I bringing on an equity partner or a private lender? There's a lot of different ways that will help you figure out what to offer if you also know how you're going to finance it and what the exit is for you. So this is a multi-layered conversation, brother. And there's a lot of different aspects and things we need to look at. More than anything on this episode is I just want to hopefully give you some clarity, and those listening, that really what we're trying to do is just quickly determine what's the value of the facility based on the income. What could the value be? And that's in that second part of the equation. That's where we go deeper into the underwriting spreadsheet that we use inside the Storage Wins community.
Yeah, that's great. I love it. And
helpful,
super helpful. Yes, I already feel more confident in evaluating properties now just from talking to you for the last 30 or 45 minutes. But yeah, I'd love to do a part 2 and see the whiteboard calculation as well whenever we can get that coordinated.
Yeah, that'd be great. And maybe what we can do is, it'll take us, just because of the holidays, it'll take us some time. We'll probably do that after the new year. But maybe we can use an actual deal that you're working on with actual numbers, or maybe even your facility. We can project out and we can go a little bit deeper there.
Love it.
All right.
This is awesome,
guys.
Thank you so much, Alex. I appreciate it.
Hey, man, I appreciate you, and everybody listening. Make sure you're subscribed to the Storage Wins podcast and on YouTube. And I look forward to connecting with you on the next one.